My name is Tomasz Piskorski, and I'm an Edward S. Gordon Professor of Real Estate at Columbia Business School. I teach a real estate finance course, and I also developed a class called PropTech and Real Estate Disruption that talks about technological innovations in the real estate industry. In terms of my research, I do work on financial intermediation and banking, real estate finance and housing, as well as on financial technology and PropTech. Recently, I've been looking on the impact of the aggressive monetary tightening by the Federal Reserve Bank on the financial stability of US banks. Because of the rapid interest rate increases, we find that the value of bank assets is about $2 trillion lower than before. That means that close to half of US banks currently have the market value of the assets less than the face value of their liabilities. This doesn't mean that all these banks are insolvent. It depends on the behavior of the depositors, which account for vast majority of bank funding. And in particular, uninsured depositors who stand to lose their money if the bank fails. We show that a given rate of withdrawal by insured depositors can result in between 200 to up to 1,600 banks failing. For main analysis, just look on the impact of high interest rates on the bank solvency. But we haven't really considered the credit risk yet. And this is what we do in our follow-up work. We see what happens if a given share of commercial real estate loans default at each of the US banks. While we look on commercial real estate, it's a sector that is under considerable stress, especially the office sector due to work from home, high interest rates, and potential softening demand due to things like tech layoffs. And what we find out is that because of the increase in interest rates and erosion of asset values of the US banks, they're now in much more fragile position, and in fact, additional number of banks could fail due to the commercial real estate distress. Note, if this distress would manifest a year or 2 years earlier, we wouldn't really have a problem. The main takeaway from our work is that the US banking system is in a very fragile state. And this can have important consequences for a US economy, especially if banks would curtail credit to households and firms. The federal authorities responded to the crisis by providing credit facilities to banks and, in some cases, guarantees of deposits. This short-circuited the run on banks and temporarily prevented wide-scale bank failures. However, it also means that some of the at most risk banks will have to be shut down or potentially merged with other banks. In the long term, the current crisis will likely significantly impact financial regulation. In the minimum, the federal authorities should stress the banking sector for the potential of interest rate increases, and there will be likely also push for more risk management practices at banks. One potential solution is to require banks to increase their capital buffers. That will make them more resilient to future increases in interest rates or similar shocks. Any crisis generates great opportunities, and those that take advantage of them are likely to benefit a lot.